VCs are from Venus and entrepreneurs are from Mars.
Both sides actually want to be able to do a deal or find a match, and yet there's some misunderstandings. Each one wants to do a dance, but the dance is not in harmony, and therefore they're kind of off step.
The differences that you see when you're investing in, say, a pre-seed or seed versus a Series A.
There was a weird phase in between from, say, 2019 to early 22, where it all sort of weirdly meshed together. In the sense, it was hard to figure out if a company is pre-seed or seed or Series A. The only way you could distinguish by the amount of money they were raising. As crazy as that sounds, and in some ways that is also true for many AI companies today.
How do you filter through the noise?
Sometimes AI may actually get in the way as well. So, for example, AI may convolute a message that would be simpler if you had not inserted AI into the positioning or the messaging.
How do you strike a balance between investing in disruptive companies versus investing in companies which are kind of doing incremental progress within existing tech?
It is too early to talk about disruption when the base rails of the new age digital infrastructure, new models of doing business, new models of consumption, supply chain have not yet been established.
In this episode of Constructing Tomorrow, we have Shubhankar Bhattacharya. Shub is a general partner at Foundamental, a global venture capital firm investing in the construction technology space. Shub has over 15 years of experience as a VC investor, founder, and operator. He currently leads Fundamental's investments for Asia Pacific and Africa region. This is a two-part series, and in this episode, we discuss what is VC and how it operates, fundraising as a VC and as a ConTech company, funding strategies and differences between seed rounds and Series A, disruptive companies versus incremental progress companies, exit strategies, merge acquisitions, and IPO, how to make strategic decisions, and much more. With that said, I bring you Shub.
Hi, Shub. So good to have you and welcome to the podcast.
Sid, it's a pleasure to be here. Thanks for having me.
Yeah, I'm super excited to learn everything there is about VC in construction. But to start off things, I wanted to talk about your journey. So you started your education with chemical engineering, you did your MBA, then you tried your hands being an entrepreneur, you joined an Indian venture capital firm, and now you founded Fundamental. So looking back at things, what would you say were your top two or three pivotal moments that shaped your journey?
Oh, wow. Okay. I wasn't prepared for that to be the first question, but there you go. I guess we go right into the deep end. I think starting Fundamental by itself was probably the most important point for me in my journey in so many ways, and happy to get into it in more detail because I think while I think it is one it could be seen as a continuation of being a VC. I also see it as in my own capacity transitioning to once again returning to being a founder, obviously in a very different capacity. I must say it's quite different from founding a startup, for example. Many similar challenges, but also very different kinds of challenges. Um, Actually, I would say, maybe I'll go off script a little bit. The second most pivotal journey, or maybe it was actually the first, was actually also meeting my wife. And I think that, and obviously at that time she was my girlfriend. I think in so many ways it helped me also navigate many interesting phases and challenges of my professional journey as well. So I'm actually very grateful for the role she's played as well all along. So I'm very grateful for that. Um, and maybe staying true to I guess your question, the third most important chapter or transition, depending on how you look at it, was actually managing the switch from being a founder to a VC, which I think lot of times people think it is easy or straightforward or comes naturally. um, Maybe it does to other people, I don't know. For me it was a tremendous rush. You get a very big intellectual high when you start off as a VC. But it also comes with quite a bit of adapting, I must admit. And it only became obvious to me a year or two down the line, if I'm being completely honest, at how much of a attitude change I needed to incorporate to fully transition into being a VC.
You mentioned a couple of good points there, like because you've experienced both sides of the venture table, and we'll get more into that. But I usually like to start off at ground zero. So if you can give a VC 101, what is VC, how it works, and how it operates?
Sure. So look, at VC, what we do is we raise money. We manage money that we have raised from other sources. Could be family offices, other corporates, financial institutions, individuals, etc. We are custodians of their money, and we have a fiduciary responsibility to use it responsibility and generate a return on it. And the way we seek to generate a return as VCs or venture capitalists is to invest in early stage, highly promising companies with a very disproportionate risk reward equation, that is proportion for or the opportunity for very high reward, maybe hundreds of times or maybe even 1,000+ times of the invested capital, but also very high risk, which means a very large proportion of companies we invest in eventually return nothing at all. So that's kind of like what VC is.
So you mentioned that you also have to raise as a VC, you also raise capital from limited partners or individual institutions. So I wanted to ask, I feel like now it is still more easier to raise money from these institutions as you see a lot of VC firms putting money in construction tech companies. But early in the day, how difficult was it to convince the limited partners to kind of, hey, this is construction tech. Can you can you provide some money for it?
You know, the interesting thing is, I think on a whole, I would say, compared to what I hear from many other friends and peers of mine in the industry about how difficult fundraising is, I don't. I think that is true in general. I think fundraising is hard, or has been hard in general in the last 2 years. I feel like progressively things have gotten either a little bit easier for us, or maybe we've gotten a little bit more used to it over a period of time as our track record has grown in the industry. But in the beginning, I have to admit, it was very, very hard. It does feel so very much, you know, if founders or especially construction tech founders are watching or listening to this, you're probably wondering, hey, you know, I have to sell this story about construction tech and where it's going. It's actually a whole, believe it or not, in many ways, it's actually even harder for a construction tech focused VC to raise a fund, because at this point you're not selling an asset, you're selling an asset class or a pool of assets, but only restricted to one sector. And it is not as straightforward or as easy as people think. It also comes with quite a bit of challenge. It is also subject to a lot of market movements, uncertainties, macro, and so on and so forth. But touchwood, things have not been too bad. I think we have, thanks to a few good bets we placed along the way, uh, our journey has also been gathering momentum as we have kept scaling things along through our multiple funds.
Have you seen any kind of hesitation from this limited partners about investing? Like, does something come up to come top of your mind about, oh, hey, there might not be returns. It's a good idea, but maybe the market timing isn't right. Have you seen those kind of reasons from them?
Oh yeah, I mean, look, at this point, truth be told, while you know you and I are believers in construction tech, uh, and a lot has changed since we started Fundamental in 2018, and I think construction tech today is at a very different place from where it was a few years ago. But even with that said, it's still considered like this new, somewhat niche emerging theme. Although I find that extremely odd given how large construction is as an industry, depending on the estimates, anywhere between 10 to 13 trillion dollars globally as an annual output. But be that as it may, for a lot of money managers and financial investors, it's still seen as this somewhat niche, maybe not so scaled up sector with a lot of things still remaining unproven and a lot of questions still unanswered. But with that said, over the years, we've seen more and more people look at the space with more interest and wanting to get more excited. So, directionally, things are definitely looking very positive.
Awesome. And now switching to, okay, the VC forum has raised money. Now you need to deploy that money into construction tech companies. So when you invest in construction tech companies, what are some of the key parameters that you look at?
Look, I wish I had like a straightforward checklist I could tell you. maybe just to take a step back on what we do at Fundamental, just so that I can answer it with the appropriate context. So we invest in construction tech, as you rightly pointed out, but we invest around the world. And when we say around the world, it's quite homogenous. We've invested in all six continents so far, and have a fairly uniform spread across North America, Europe, Asia, and also a pretty good coverage in markets like Australia, Africa, Middle East, etc. Uh, the thing is, I wish I could tell you a straightforward checklist or things we like or look for, which applies uniformly in every market. That is just not the case, right? I think, and that is especially very divergent in the context of construction, because I mean, you're based in the US, and I'm sure you've seen what sort of technologies or methods or processes are prevalent in the construction industry or adopted by the leaders there. That would be so different from what you'd see in a market like India, for example, or say in China, or in Europe. Also, because the nature of construction is very local, very project based, it doesn't lend itself very well to seamless digital cross border transference of ideas uh, and things of that sort. So there is definitely a hyper local aspect to these things. And all these different markets, they are in very different and non-homogeneous states of how economically developed they are, the cultural significance of working with large groups of people. And the reason that's important is construction, as a nature of industry, just tend to employ a large number of people, a lot of blue collar workers as well, for instance. And so, because our objective eventually is to make a sizable return, the question we always have to ask ourselves is, what kinds of solutions and business models does that market need right now, and what will likely gain a rapid adoption and appreciation over the next, say, 5 to 10 years. And the answer to that question varies depending on the markets. So something that works in the US might not work somewhere else, and vice versa, of course. So yeah, I mean, I guess we have some overarching principles, but not so much a checklist that we that can perhaps apply to every investment.
So the key takeaway here is obviously all the markets are different and you have to analyze for region, but then also when you're kind of making a decision, think long term, 5 to 10 years on what this would scale like. Is there anything that you would like to add in here?
I think that's a good summary. That's a good summary.
And do you guys just invest in early stage or also series A, B, and so forth?
So, look, we prefer being the first investor in pre-seed and seed rounds, ideally as the lead investor of those rounds. Every now and then, we will consider later stage rounds, but that is not what we normally do. That our bread and butter would be pre-seed and seed rounds. So, no stage is too early for us, basically.
It's, and what are the differences that you see when you're investing in, say, a pre-seed or seed versus a series A?
So, today the contrast is slightly clearer, and it was very, very clear, say, 6 years ago. There was a weird phase in between from, say, 2019 to early 22, where it all sort of weirdly meshed together. In the sense, it was hard to figure out if a company is pre seed or seed or series A. The only way you could distinguish by the amount of money they were raising. As crazy as that sounds. And, in some ways, that is also true for many AI companies today. It's hard to distinguish how mature these companies really are if you filter out the amount of money they've raised. But look, at a high level, pre-seed can be, as early as it gets. It could literally be one or two people with an idea. That's a pre-seed, frankly, right? Pre-seed could also be a product is up and running, and you finally have your first a bit of revenue coming in, or maybe no revenue, you just have a product. So very, very early is pre-seed. Seed would be something where, moving on from what we mentioned in the pre-seed, you have maybe your first product or your business model starting to show signs of adoption with a bit of repeatable motion happening, either in terms of traction or in terms of the product being used. That is probably a sign of a good time to call it a seed round, or to raise a seed round when you're showing up in that aspect. From there on, it gets less and less precise, I must admit. At a very high level, Series A would be when the motion and the adoption becomes even more predictable, to the point where you can perhaps see signs of product market fit, a clear resonance with what the business is offering, and that the market is accepting it.
Mm. I think that was a great breakdown. And I'm kind of curious when it comes to investing, how do you strike a balance between investing in disruptive companies versus investing in companies which are kind of doing incremental progress within existing tech, if you will?
Hmm. Actually, that's a very interesting question, and I have a perhaps unpopular take on that question, especially when applied to investing in construction tech. So I think anything which tries to disrupt the status quo when it comes to existing customers' behavior, I think the time and the place is not right for such ventures in construction tech. And what I mean by that is, we're still at the dawn of construction tech. Imagine, it feels analogous to me, like, maybe we are somewhere around 94 or 95, and we're talking about internet and e-commerce solutions, and their relevance. That's perhaps where we are with construction tech today. So it is too early to talk about disruption when the base rails of the new age digital infrastructure, new models of doing business, new models of consumption, supply chain have not yet been established. And I think the core there is to align existing behaviors and patterns as best as possible with new methods of doing it more efficiently. So, in other words, I personally would not be looking at disruptors of existing behaviors. I would look at enablers of existing behaviors, or even encourage solutions which encourage existing behaviors, and to do it more repeatably, more scalably, and more efficiently. If you had to insert disrupt somewhere in there, I would say disrupt maybe firms because they enable existing behaviors. They're disrupting existing incumbents which got in the way of these existing behaviors. Although that is not the classic definition of disrupt, but that is perhaps the only interpretation I would accept. So, in fact, what I look for is businesses which encourage and foster existing behaviors and allow the users to do it much more easily.
And so there's a lot of companies building right now, especially with AI. As a VC, I'm pretty sure you get approached by a lot of construction tech founders, right? So how do you filter through the noise?
So I look, AI by itself doesn't add or subtract a whole deal of excitement for me, I must admit. So I tend to look at every company or business or a piece of technology as a standalone thing, where to evaluate a whether it is aligned with what the market needs, and whether there is opportunity for us to make money off of it. To be quite frank. Um, if AI enables that or enhances that sort of motion even more, that's fabulous, right? In some case, sometimes AI may actually get in the way as well. So, for example, AI may convolute a message that would be simpler if you had not inserted AI into the positioning or the messaging. But AI by itself probably won't mean much in the context of construction if that's how you lead in with. You probably have to lead in with the value proposition or the business model, and then speak about how AI enhances the use case. That's my opinion.
And would you say that when you're coming up with your value proposition, how many product market fit or potential product market fit you should have? Because if you just go with one, from the outside, I feel like that wouldn't have much of your strength if that gets done by some other company, say. So is it like you need to have a minimum of, oh, hey, at least you need to have these two, three features, and that's your strength so that it doesn't get copied?
Hmm. It is hard to be honest. I wish I had a specific answer for that. But my hunch and my heuristic, if I had to quickly give you a knee jerk response to your question, would be, so the way you build greatness and competence with AI in general is that you train the model either on a large amount of data with lots of repetition, where the response becomes very accurate, very predictably. That sort of function, of course, is easier to do if you start off with a single function and achieve a very high degree of proficiency on it. For most startups, and this is by no means a generalization, but for most startups, trying to do too many use cases like that would usually mean that all of them would be sort of mediocre or not great, would probably just be functional but not great. So usually at the start, you're looking for a trade-off where you demonstrate a very high degree of proficiency in one thing before you do the other.
Got it. And I'm kind of curious when it comes to the exit strategy because we don't see a lot of merger and acquisitions or IPOs coming out of construction tech. So as a VC, what's your vision like when you're investing in a company? Obviously, you would want it to go IPO, but like, what are the general exits that you have seen?
To be fair, we have actually had a few exits already in our portfolio, and we are also looking at a few other exits coming through fairly soon, like very substantial and meaningful exits as well, along the lines of what you said, IPO, M&As, etc. I don't want to give any more information, specific information out, but I'll leave it at that. In general, your comment is valid in the sense there have been exits, but there perhaps haven't been as many as yet to establish a clear cut case of, for example, a huge new wave of construction tech funding and venture creation happening. My hypothesis is that we are on the cusp of that happening, in the sense usually what happens is, you if you look at the different steps needed to establish that a new trend is underway or has clearly taken root. First you see founders taking a bit of a bet in creating ventures. Then you see, the industry or other stakeholders adopting it. Then usually eventually you see money following in terms of investments. Along the way you'll see another cycle of founders getting excited and doing it. And usually exits are one of the last steps which establish the legitimacy of a space. So while we have had some in construction tech, have we had enough? No, I would fully agree that. But I think once that happens, we'll then be at a state where it'll be construction tech will become an obvious space for a huge amount of money to go in. And I think we might be a few years away, maybe not too long, but a few years away from that. But I feel like we're on the cusp of that happening, and therefore revealing that construction tech is a very obvious opportunity to back.
I was also actually, when I was doing research, I found that you wrote a book long back, and it was called VCs Are from Venus and Entrepreneurs Are from Mars. I wanted to understand what the statement meant.
Yeah, look, I mean, so as I mentioned, for me, the transition of being from being a founder to then being a VC, it was a fascinating journey, and I actually found it a very fulfilling transition and a journey in so many ways. In sort of because quite often when I would meet founders in my early days as a VC, that is, I often kept asking myself how I would have done if I were a founder in their shoes, and also often comparing how many mistakes I made back when I was a founder pitching to other investors. And that led me to wonder quite often, both sides actually want to be able to do a deal or find a match, and yet there's some misunderstandings. Each one wants to do a dance, but the dance is not in harmony, and therefore they're kind of off step. And the thought process was, are they perhaps speaking different languages or different ways of thinking, but perhaps you can align them in a way. So the book basically tries to explore these different dynamics or the different personas. And if you're wondering, it obviously draws from inspiration from the other much more famous book, Men Are From Mars, Women Are From Venus, which does a very similar sort of analysis, but on men and women in a romantic context.
Now that makes sense. Uh, so you touched upon how you kind of in that book wrote down your experiences being on both sides of the venture table. So you've been investing for almost a decade now. What has been your biggest learning so far?
Hmm. I think the for me the most important is, if I have a hunch about something being right or wrong, to not give up on that hunch because other people are talking me into or out of it. And I'll tell you what I mean by that. So when I did an analysis about a couple of years ago, And I analyzed what were my biggest, most successful investments thus far, and what were also my biggest regrets so far. There was a surprisingly common pattern. And what I mean by that is, in the investments I'm most proud of, they happened at a time when I was proposing the investment. There was a lot of pushback from my colleagues and partners. And yet, at the end of the day, I was able to push the decision through and make the investment. Although at various points of time, it seemed like that would not happen because there was overwhelming resistance and pushback to it. And in the biggest regrets I have, it is actually because I initially was excited about making an investment in the company, but then a lot of people talked me out of getting excited about the company. So, by the way, this is not to say that I'm a genius and I'm always right. That is not the takeaway here. I think every one who's been in this profession, if you're listening, you'll probably identify with what I've just said. You'll have these aha moments which you feel like acting on, but usually the herd mentality or the herd mindset takes over, where we seek comfort in knowing that others think a certain way, and therefore we want to align with that sort of thinking. So, at least for me, I like to protect myself from joining the herd. And that for me has been the biggest learning. To be clear, it's also a feeling of great discomfort, because the one thing that the herd mentality gives you, it's a constant feeling of comfort because you don't have to stick your neck out. You're always part of a group, and therefore, because you're part of the group can't blame you. So that's the comforting aspect of being part of a herd. So it does lead to inherent discomfort. But at least my opinion is, if you're ready for the discomfort over the long term, it does tend to pay off very well, especially in this profession.
That's an interesting take, but I have a follow-up question on this. So you mentioned about um, following your instinct more when making decisions, but obviously when you're making a $1 million work decision, right? How do you kind of balance between your internal instinct versus the market timing or the market condition at that point? Where's that balance like? How do you kind of come to a decision?
So it's not, I don't have a precise answer, just to be clear, but and different VC professionals will probably give you very different answers. I think usually the answer you'll get to hear from a lot of people is that, hey, VC is not a science, it's an art. Or some others will say, hey, it's not an art, it can be made into a science. I actually disagree with both these notions of VC. I'd like to think of VC as a craft, right? As in similar to, for example, a carpenter or someone who's a very skilled worker for something. And what I mean by that, or maybe a skilled painter, for example, or an artist, right? And what I mean by that is, what VC needs is, of the main skills that are employed in VC, that's analysis, sourcing, LP relations, fundraising, diligence, all these kinds of, and obviously quite a few others as well. You need to be competent at all of these things, but have superpowers in one or two. And when I say superpowers, it's a superpower manifested in a very unique way, that is uniquely a signature style or a signature aspect of yours. And that is what makes you as a person memorable in this profession. And that is your unique craft. And as you go along, evaluating more companies, doing or not doing more deals, right, and hopefully tasting success along the way, you also get eventually feedback on what's working and what's not working, and you incorporate that into your style, right? Similar to how, for example, a painter would over a period of time recognize, hey, which colors blend in what proportions and what sort of effect they have in the painting, and how they play out, whether they harmonize with other combinations or not. Over a period of time, you're expected to incorporate that into a living craft which evolves on its own. And the reason why it needs to evolve, also just to make sure everyone understands this, is because what worked 10 years ago as a business might not be relevant as a venture case today. So you also need to keep evolving, be open to new ideas, be open to new kinds of founders, be open to new business models, etc., and not rest on the laurels. So I think of it as an evolving craft, which is, and that's how I like to look at it. So, which is why my style would be very different from each of my other partner styles, and I think that's a very good thing. In fact, if we all look the same, frankly, we could be replaced by robots today if that were the case, and that would be a shame. I mean, that may also be pretty nice, but at least from my perspective, that would be a shame. But I think there's something uniquely poetic, and human in its more core form, most core form, to think of it as a craft, and that's what makes it quite fun for me as well.
Mm, that was insightful. Just thinking, because I don't think I ever thought about VC as a craft. You would always think of it as analytical mostly. But that was an interesting take. Um, and you kind of touched upon this, but what does a normal day look like as a VC?
I think so. It's more like batches. So not every day is the same, but it's usually a mix of talking to new investment prospects, doing diligence or evaluating companies that bubble up in terms of high levels of interest, preparing investment memos for them. Then on the other side, the companies where we've already invested them in them, doing reviews, talking to them, trying to see if there's any problems that may need to be solved there. Also, obviously, evaluating additional follow-on investment decisions for them. Then we also have, excuse me, also have to manage our LPs or limited partners, that is the investors in our fund. When we are raising money for a new fund, that's also something which gets added to a regular day. Alongside all of this, every now and then we create content as well, which is also a fun little thing to add on. Usually, when you do all of these things, there's also a few things that get added here and there. Stuff like managing specific colleagues and resources within the organization and so on. And now, what I'm describing is not necessarily a VC function, more of a business leader function, which is relevant to a certain degree in venture capital as well. So there's a few different hats you need to keep wearing, and usually you also need to decide which hat is most relevant in that moment. Sometimes you can also make the mistake of wearing the wrong hat, and therefore not doing your job the right way.
And what if someone from like a core construction field wants to get into VC? I guess I'm curious what the path looks like. And do you need an MBA? Or like, do you really need an MBA to be a VC, or what's your take on that?
No, so short answer, you don't need an MBA to do a VC, because VC is one of those professions where frankly no one really knows what makes a good VC. I think we all, my personal opinion, we delude ourselves when we say things like, hey, you need to be an engineer or an MBA or have so and so degree or go to these schools. None of that is relevant. If I'm not mistaken, the founder of Sequoia Capital was a journalist. uh, I think so, to the best of my memory. Please do verify if that is valid. But I think either the founder of Sequoia or another very, very famous VC firm was a journalist, right? And there have been lots of examples where, for example, I think someone had even done an analysis. People with a law background also make for great VCs because they have an edge when it comes to negotiation. So this is where I come back to my comment on VC being a uniquely personal craft. You have the freedom and flexibility to decide what your superpower is, and that can also be a function of either what sort of former work experience you had or what your educational background was. So in answering your question, can someone with construction experience also get into VC? Absolutely. Their superpower might be the domain expertise. They may need brushing up on a few other aspects of the job or the industry. uh, in my opinion, that's not the gating factor. There is not so much the education or the background. It's intellectual curiosity and hunger to learn more, which I would like to believe most people with aptitude solve that by themselves, and therefore I think it's certainly doable.
Awesome. And I was also curious about so when you're investing in any construction companies, you obviously raise capital, but is there like a number that you have in mind? Okay, this year I want to deploy this much funds. I would assume there's like a strategic plan on, okay, this year maybe I want to invest in 5 companies or 10 companies. Is there something like a roadmap, or is there isn't really anything?
So I know that with many other VC firms, that's how they operate. It isn't so with us. So we don't really have a set allocation. I mean, we have at various points of time done way more than we thought we would. At certain points of time, we've also done less than we thought we would. We have also, at certain points of time, invested a whole lot in one geography, not so much in other geographies. Then we have also reversed the trend in another time period. So for us, it's all about where we see opportunity. So we'll always chase opportunity, and we're not really constrained by either the rate of deployment or where we should be deploying in any of those things.